For example, a few years ago I was posting my lecture videos just on like an internal Marshall video server that it didn't have very good clarity. It wasn't accessible outside the university network, so it was actually a student suggestion that I put my classes on YouTube. So hopefully if you have some ideas on how the class can be improved, I'm glad to hear it. Let's review a couple of announcements. I've graded all of the projects. So if you want to see where your grade is, then you can have a look at MyMU in the Blackboard area. And I guess I forgot to mention here that we've got one more homework assignment due, right? So homework, is it 14? It's due on Wednesday. Due Wednesday, December 4th. Okay. What's that? 13. Ah, okay. Still a lot of homework. All right, so yeah, you've got a homework due on Wednesday of this week, and then the final exam at the end of next week. Just to review the parameters of that one, it's from 10:15 until 12:15. Comprehensive, meaning that you really should review the concepts and problem solving from the earlier parts of the course in case some of that's become rusty over the last few months. There's going to be an added emphasis in terms of earning points on the material that you haven't been tested on yet, so more of the questions proportionally will come on the stuff since exam 2. And then you can have 3 pages of notes, and you ought to bring your computer because there will be at least one question that you'll need to solve using Microsoft Excel. So does anybody have any questions about the announcements? Okay. So, yes?
Are we allowed to bring previous note pages that we've already created?
Yeah.
I don't know why I wouldn't. I was just making sure.
Yep, that's fine to do that. That's kind of the mindset of the 3 equation pages, is that you could bring the first 2 that you'd already made plus put together one more if you like. Other questions? All right. So before Thanksgiving break, we talked about taxes. We focused on property taxes. We talked about excise taxes, things like sales and VAT taxes. And all of those are important, but probably of all the taxes we pay, what gets the most attention for a lot of people is income taxes. And that's because it's the biggest share of the taxes that we pay here in the United States. In other countries it's a little bit different, but it's important, and it's also complicated. A lot of people are intimidated by income taxes, and so you'll notice around tax season that there's tax prep places set up at the front of Walmart, or there are storefront tax preparation businesses like H&R Block that you can go to and just basically take them all your papers and they'll fill it out for you. But what I'm hoping we can do today is demystify some of that. And of course there are really good tax prep software available, but you don't even necessarily need the software in a lot of cases. If you have a relatively simple financial picture, you can just fill out the forms directly. So we're going to go through some of that. Almost every place in the United States has, almost everywhere in the world has an income tax. There are a couple of places in the Gulf that don't have tax. But you can see that in the United States, the top income tax rate of between 35 and 40% is kind of in the middle range. There's most of Europe, the tax rates are higher. But it was instituted in the 1860s to help pay for the Civil War. And back then, it was only 3% of income over $800. And the tax rates are a lot higher now. You can see that the top income tax rate now, I think it's 37% once you get above a certain amount. We'll look at the progressive structure in just a minute, but it used to be a lot lower, and for a lot of Americans back in those days who were making less than $800, it wasn't due at all. And then after the Civil War, it was reduced to 2% of income over $4,000. And so that, in terms of equivalent money today, that was about $113,000. And so it's definitely gone up, as has government spending. But I think probably we'd all agree that life is better now than it was in the 1860s, both in terms of the social safety nets and the level of security that's provided by the government and the services like schools and roadway networks. So this is a look at a lot of the European nations, both their income tax rate and the total tax burden as a percentage of what people earn. And so what I wanted to show you here, that in the United States, on average, we pay about 11% income tax, and it varies a lot depending on how much you earn. The more you earn, the higher that rate goes. And so that 11% is kind of based on the national average GDP per capita. But the total tax burden is 18.5% in the United States. And so if you want to think about what's the difference between the income tax and the total tax burden, it includes things like property tax, the effect of excise taxes, sales tax, and the tax that's collected indirectly in the form of tariffs that are levied on the goods that are purchased. And so you see that in a lot of European countries, the tax rates are quite a bit higher. You know, if you compare the United States 11% tax to the 34.5% in Denmark, that's triple the tax rate in Denmark. It's interesting, though, to see that their income tax rate in Denmark of 34% is actually higher than the total tax burden. And you may think, how is that even possible? It's because some of the income tax is then just redistributed to people. So, yeah, we will take a look at this progressive tax structure. What it shows is that we're going to go through the 1040 form here in a moment, and a certain fraction of the money that you make each year is totally tax-free. And so for 2023, that was, for a single person, $13,850. So $13,850, you can earn that without paying any tax. But then above that is considered your taxable income. And there are a few other deductions as well, but once you get into the taxable income range, then the first $10,000 that you earn, approximately $10,275, you're paying 10% tax on that. And then for every dollar above $10,275, then it begins to be taxed at 12%. And so you can see that the taxable income between $10,276 and $41,775 is taxed at 12%. So to find out the tax owed, you could either calculate it individually, and so 10% of $10,275 you can see is this amount, $1,027.50. Sometimes people are under the misconception that, for example, if you go from $89,075 to $89,076, you see how it goes from 22% to 24%? Sometimes people think that you wouldn't want to earn that extra dollar because then all of your income would be taxed at 24 instead of 22. But that's not the case. It's only the additional income above this threshold of $89,075. And so it's never like going to be a huge jump in the amount of tax you pay. You see the 24% to the 32%, that is a big increase in the rate, but it's not the entire income that is subject to 32% when you get into that range. It's only the additional dollars above $170,050. So this column, you could find out the total tax owed based on the taxable income, and it's a little bit different if you are married filing jointly, if you are filing as a head of household, or filing single. And we'll look at the tax tables in a minute. But this is what people mean by saying that the income tax in the United States is progressive. It means that as your income goes up, then the tax rate also increases. I saw an interesting statistic in the Wall Street Journal over the weekend, and it said that the top 1% of Americans pay 40% of the nation's taxes because they have, most of the income. So 1% of people is paying 40% of the nation's tax because of the progressive income tax structure. All right, let me hand out a copy of what we're going to be working through for the rest of class, and I'll pull it up on the screen as well. We're going to look at yeah. All right, this is what you would typically get in the mail each year, summarizing how much you earned from your employer, how much income tax you've already paid. It's called a W-2, and a lot of people look forward to receiving their W-2. Usually it's people who have overpaid in taxes each year, and they're excited to get a tax refund. Not everybody gets a tax refund, though. If you haven't had enough money withheld throughout the year, then you may have to pay tax at the end of the year. And if you end up owing money, then depending on the circumstances, you may have to also pay interest, because the federal government doesn't want you to wait to the end of the year and owe them money. Can we get a copy of it? All right. So this is the W-2. You can see the amount of wages that have been earned. So this person has $83,281 in Social Security wages, and the difference between the Social Security and Medicare wages and then this box 1 is that a certain portion of the income that Charlie Day earned is going to their retirement account. And so money that you put into your retirement account actually decreases the amount of taxable income you have. So it's kind of smart from several different perspectives to save money for retirement, because on the one hand, the money that you put into a retirement account, it doesn't get taxed over the years that it's in that account. And so the money that you put in there is growing without the drag of paying income taxes each year. It's just continuing to grow, and then you pay taxes on it at the very end when you're withdrawing the money during the years of retirement. So it's good in that sense, but it's also good because it reduces your tax burden now. So they are kind of creating the incentive for you to contribute to your retirement account by allowing your wages to be lower than they otherwise would be. But you still have to pay Social Security and Medicare tax on the full amount. It's just your federal income tax, which is what box 1 is related to, is reduced. So you can see this person has already, over the course of the year, had $3,431 withheld to go towards federal income tax. They've already had some money withheld to pay their Social Security tax, Medicare tax, and then just information about the employer is here, the person's Social Security number, their address, and you see there's also some details related to their state taxes that they've paid. And so they've paid $1,251 in state income tax. It looks like whatever locality they're working in doesn't charge a local income tax. But here the retirement plan box is checked, and then this box 12D is how much money was withheld to go into the retirement plan. And so that's explaining the difference between the Social Security wages and the wages, is the amount that was withheld for the retirement plan. Okay, so some other information about this person is he has a Robinhood account, and he bought Bitcoin during the year. And so that's important for us to, we'll see as we fill out the 1040 that there's some stuff related to cryptocurrency on the 1040. He's got some stocks and earned $419 in stock dividends. And it was reported on a 1099 DIV. That's just a form that would have come from Robinhood. Usually in January or February each year, your banks will send you a 1099 INT. Your broker will send you a 1099 DIV or other forms if you've sold stocks during the year. This Charlie Day character didn't didn't sell any stocks but did receive dividend payments. Has a son, which is going to be important when we fill out the 1040 because you get tax credit for having children. And then he's got some additional income related to mowing lawns. And what you're going to see is you're supposed to report stuff like that. You're supposed to pay your tax on if you're self-employed and you're doing like lawn care, or if you're selling things online, have a business of any sort, you're supposed to report that income. So we're going to go through the process and see where to include all that information. So let me give you the 1040 now, and we're going to fill it out together. So if you use TurboTax or TaxSlayer or H&R Block, you know, there's probably a dozen different tax preparation softwares that you could use. They fill these forms out for you. Like, they ask you questions and you just kind of answer the questions, and then it does all the thinking for you. But part of the point, I want you to be familiar with what some of the forms look like and how it works. And so we're going to just kind of do it as if you were not using tax prep software and we're kind of going through the process yourself. So the first thing, we just have to fill out the name here. You'll just write it by hand, Charlie M. Day. The social security number, hopefully if you were doing this for yourself, you'd have that memorized, but it's on the W-2 form. In Charlie's case, 524835843. Okay, Charlie is single, and so there's no spouse to list here. Home address, 4565 McNugget Street. Okay, and that is in Fairmont, West Virginia, 25476. All right, this question here about the presidential campaign, it's kind of a weird artifact of the past. Back until about the year 2000, it was common for presidential candidates to use public funding and not have to raise money for the election, but it was limited. You know, like if they used the government's money, then they could only spend like $120 million. But it's been a long time since any candidate opted into that free federal money because they just want to spend as much as possible. So, I mean, you can check this yes if you want, but it doesn't change how much tax you owe. And the reality is that it's irrelevant anyway because the presidential candidates who are eligible for the money haven't taken it for years and years. So I just leave it blank. Charlie M. Day is single, so you check that, and it's going to be important later when we calculate the standard deduction and when we go through and find out the amount of tax that's due. But once you get married, it's better to file jointly because you get more deductions and a lower tax rate if you do married filing jointly. There are only rare occasions when married filing separately would be the way to go. You know, all of these are kind of obscure, like qualifying surviving spouse and head of household. So you can look up the definitions for those if it ever comes to that. Okay, digital assets. The government wants to tax digital assets when they're sold, or if you have digital assets and they do a hard fork, which means, you know, you have Bitcoin and now they also invent Bitcoin Gold. Technically, when there's a split between Bitcoin and Bitcoin Gold, you immediately are getting this new cryptocurrency that's in theory worth something, and you have to pay the tax when it does the hard fork. And so the questions here are related to, did you receive Bitcoin basically from mining as a payment, or if you went through like a staking process, or did you sell it? Because they're only asking for those kinds of transactions that would make it taxable. So if you own Bitcoin, but you didn't have any kind of hard fork during the year, if you own Bitcoin but you didn't sell it, you can click no. And if you bought Bitcoin, you can click no. So in Charlie's case, he bought Bitcoin, but there was no fork, there was no sale, so he received no income during the year. So we're clicking no to the box there. Okay, standard deduction. If your parents are still claiming you on their taxes for a tax credit or for dependents to increase the amount of the standard deduction, then you have to mention that on your tax return. So no one else can claim Charlie. He's a fully independent grown adult. But when I was in college, for example, someone else was claiming me as a dependent. My parents were, and so I had to click the box there, and it increased my taxes by a little bit, but them claiming me as a dependent decreased their taxes by a lot. So, overall it was good that they were claiming me as a dependent because I was more valuable to them as a dependent than I was to myself for the standard deduction. But in Charlie's case, we're leaving the standard deduction blank. Charlie's not blind or born before 1959, so none of the age or blindness things factor in. Charlie has a son, Graydon, Graydyn, Graydon Day, and you got to put in the social security number, 206-714531. Relationship is son, and Graydon qualifies for the child tax credit. So click that box. That's something we'll take a look at in a minute, the child tax credit and the value of that. Okay, so now we're supposed to start putting in the income type stuff, the income information. So it says here for line 1A, enter the total amount on box 1 of the W-2. So if you look at the W-2, that's the wages, tips, and compensation. So that's 78567. Okay, so that was the wages, tips, and other compensation. A lot of these aren't going to apply. We're going to go box after box, and so household employee wages not reported. No, that's not applicable. Tip income, not applicable. Medicare waiver payments, not applicable. Taxable dependent care benefits, none of this. The next thing that is going to apply in Charlie's case is other earned income because of the $800 he made mowing lawns. And so put in 800 in box 1H. You'll see that there's some interesting things here like non-taxable combat pay. That doesn't apply in Charlie's case. He works over at, looks like, Green Bank Enterprises, and so that's not combat pay. When it comes to interest and dividends and so on, some of it is taxable and some of it is tax exempt. So for instance, municipal bonds are tax exempt. And so if he had held some municipal bonds that aren't subject to federal or state taxes, then the amount of interest of those bonds would go into 2A. But the interest that Charlie has is from a bank account, and it was reported on the form 1099 INT. So that was $2,431 in taxable interest. The dividends that Charlie made are ordinary dividends, and those that would be mentioned on the form that you get from the broker. So on the 1099 DIV, it would mention if it's qualified or ordinary. And the difference is in how they're taxed. Qualified dividends, it's some obscure loophole that rich people use to avoid paying the full income tax. I think it's qualified dividends maybe are taxed at a lower rate than ordinary dividends. But Charlie's dividends are ordinary, and that was $419 in ordinary dividends. There's no IRA distributions. That's what you start withdrawing your withdrawing money during retirement. And so some IRA stands for individual retirement account, and a Roth IRA would be tax-free. distributions from a traditional IRA are taxable, but Charlie is not yet retired, and so IRA distributions doesn't apply, pensions doesn't apply, Social Security benefits, none of that is applicable in his case. Okay, here line 7, capital gain or loss. That would be related to if Charlie had sold stocks during the year. And Charlie owned stocks and received income from them in the form of dividends, but Charlie didn't sell any stocks. And so there's no capital gains or capital losses. The reason why it asks is if you hold on to a stock for more than a year, then you pay a lower tax rate for capital gains than if you have short-term capital gains. And so holding on to a stock for only a year or less, then your earnings are charged at whatever your taxable income rate is, which could be as high as 37% for the very wealthy. But if you hold on to it for more than a year, then the earnings on stock, meaning if you sell at a higher price than you bought the stock, then it's only taxed at 15%. So long-term gains are taxed at a really low tax rate, and so that's what that's asking in line 7. In Charlie's case, there's no capital gains or losses, and so that doesn't apply. So, I skipped over where we need to do an addition in 1Z. So 1Z, it said add lines 1A through 1H. So 78,567 plus 800. So in 1Z, that should say 79,367. So that's the sum of the income and the income from work at Green Bank Enterprises and the lawn mowing income. So that was in 1Z. Okay, now total income, line 9. So we're adding 1Z and then also the amounts related to the interest and the dividends. So 79,367 plus 2431 plus 419. The total income is 82,217 in line 9. All right, now it says, look at line 10, adjustments to income from Schedule 1, line 26. Let's look at some of these schedules that are mentioned. If you look here, it's referring to, for example, additional income from Schedule 1 or attach Schedule D if required. Down here it's talking about Schedule A. Those are kind of like auxiliary forms for specific cases, and the Schedule D, for instance, relates to how taxes are treated for capital gains. And so let me open up the Schedule D just so that you can get a sense for what that looks like. So the Schedule D, it's basically asking in the year, what were your short-term capital gains? And so those were stocks that you held on to for less than a year. So it would ask you, how much did you sell the stock for? How much did you buy the stock for? And the difference between the two is called your capital gain. Or there's a capital loss, and capital losses can reduce the tax that you pay, where capital gains increase the tax that you pay. You'll sometimes hear people talking about harvesting losses. Sometimes if people are going to pay a lot of tax in a year, they could sell some stock that they know is junk, that they've lost money on, and they sell it just for the purposes of reducing the tax that they owe. So in the Schedule D, there's short-term capital gains and there's also long-term capital gains. And so those are the things that you've held on to for more than a year. So they're asking you, how much did you sell it for? What was your initial cost basis? Meaning, how much did you pay? And then the difference between the two is your gain. And then there's another worksheet that's going to tell you how much you have to pay on the earnings that you've made. And so that's like what a Schedule D looks like. If we look at the Schedule 1, Schedule 1 is going to apply in Charlie's case because he has that income related to the work that he did, the $800. So other income that isn't reported other places can sometimes show up on the Schedule 1. So you look here, there's some, gambling income would be reported on Schedule 1, jury duty pay. If you just win a prize, like Publishers Clearinghouse or something. So it's just kind of, the Schedule 1 is where you would report less common but still important sources of income. Okay, so if we go back to the 1040, so we've just filled in the 82,217. There's, in this case, the adjustments to income from Schedule 1, we don't do that yet because we reported actually the earned income here for the lawn mowing. So line 11 is just the same, 82,217. And now we get to start deducting. So the standard deduction or itemized deduction from Schedule A. Basically the way it works is if you donate a lot of money to charity, more than the standard deduction, then you have to list on Schedule A what you did. So if you're donating money to church or if you're giving money to other charitable organizations, then you'd report it on Schedule A, but there's no reason to itemize until the amount that you've given away is greater than the standard deduction. And so in Charlie's case, let's say if he gave 10% to his church, that would only be like around $8,000, whereas the standard deduction is $13,850. And so he's not going to itemize. He's going to take the standard deduction. And you look in the margin of the form here, it has different amounts if you're single versus married. So in Charlie's case, he's single, so he's going to list the $13,850 as the standard deduction. And I don't remember, Charlie has a son, but the head of household detail is, it's not just meaning that you have children. I think the head of household, it's a more obscure case than that, like where you have to be divorced and some also other considerations. But we're just going to go for the standard deduction in Charlie's case, $13,850. So now here in line 15 it says to subtract line 14, which our case is 0 because he has no qualified income business deduction. There's certain businesses like accountants or consultants who get to take a special deduction against their business income. But in Charlie's case, his $800 in lawn mowing isn't considered a qualified business, and so that's why we're leaving that one blank. So we're just basically the 82,217 minus the standard deduction is going to tell us Charlie's taxable income, and so that's 68,367. So if you think about how much Charlie actually earned, he earned 83,281, but then putting money into a retirement account brought it down to 78,567, and then it got brought down further because of the standard deduction. So he earned $83,000, but he's only going to pay tax on $68,000. And so that's why the tax rates that are shown here on the progressive structure here, it's not really that people are paying 32% tax if their income is in a certain range, because this is just referring to their taxable income. And a big portion of the income that Charlie has made isn't taxable because of the standard deduction and because of how much was diverted into his retirement account. And then beyond that, it's not all taxable at the terminal income tax rate. It's only the certain amount above a threshold that's taxed at that rate. Okay, so we're done with page 1. And keep in mind that the taxable income, I'm going to write it on the board because we're going to need to refer to it later. 68,367 is the taxable income. Okay. So now we have to figure out the tax. And if you're using software, it'll just automatically tell you what is the tax, but we can look it up. It's not any great mystery. We go to the tax tables, and the tax table is just page after page of numbers. And so what we're going to be looking for, so we're going to be looking for how much his taxable income is, and then the first column is how much tax for a single person. And so you'll notice that there's the tax amount for a single person, a tax amount for married filing jointly, married filing separately, and head of household. Okay, so we're going to scroll down to 68,000. Okay, so here's 68, and then he was 68,367. So that is in this bracket between 68,350 and 68,400. And so the tax that he has to pay is 10,350. That's the first column. And you look, if he was married, he would pay a lower tax amount. And that's because in the case of a married couple, it's two people paying tax. Presumably, if your income was in this range, they're thinking, you know, on a per person basis, it would have been lower. I guess that's the rationale for taxing it at a lower rate for a married couple compared to a single person, is they're thinking that a single person earning that much may be more well off. But in Charlie's case, 10,350. So we're going to put that here for the tax. 10,350 is the tax. Okay, any amount from Schedule 2. If you were doing this by hand, you'd need to check out each one of these schedules and kind of figure out what it's about. The tax prep software will fill in any applicable schedules that you need to know about. The child tax credit that Charlie gets to claim, oh wait, we need to add together lines 16 and 17, so 10,350. Okay, the child tax credit for the amount of income that Charlie makes is $2,000. So that's the value of having a kid in the eyes of the federal government, is you get $2,000 off your income tax. So great, $2,000 reduction means that now we're going to add together lines 19 and 20 here. The, you know, amount from Schedule 3 would be some additional credit that Charlie doesn't qualify for. So $2,000 is the sum of the credits that Charlie's earned so far. Now it's saying subtract line 21 from 18. So it's just saying if your credits are more than the tax that is due, they want to then you put 0 here because it's not refundable. So the subtraction is 8,350 is how much tax now Charlie has to pay after that child tax credit. Self-employment tax from Schedule 2, line 21. Just for the sake of time, because we're running out, I'll tell you that it was $122 that Charlie has to pay. That's the tax on the $800 lawn mowing. The self-employment tax is Medicare and Social Security. So the total tax is going to be $8,472. And then the payments that Charlie has already done is $34.31. That's how much, if you look at the W-2, during the year, he's only paid $34.31. So we add that over here, $34.31. That means that the total payments so far, plus refundable credits, Charlie doesn't have any refundable credits, is $3,431, which means he's going to have to actually pay the federal government a lot, $5,041. So he's not getting a refund. You only get a refund if you have more withheld during the year than the tax that is owed. But in Charlie's case, for whatever reason, his employer wasn't withholding enough money through the year to mean that he gets a refund. So he's going to have to write a check to the government, $5,041. And if that was his second year in a row having to pay more than $1,000, then he'd also have an interest penalty. If it's your first year that you've owed more than $1,000, they generally waive the interest. But they kind of don't want people avoiding paying tax through the year. They'd rather have you doing withholding at work so that they get their money sooner. So then the only other thing that Charlie would do is sign, print, and mail it in before the deadline, which is usually April 15th. And that's basically the 1040, just to give you a sense for what filling that out is like. We're out of time. Remember that what you've got on your plate right now is homework 13. That's due on Wednesday. And if you have any questions about how I graded your project, feel free to stop by my office and I'd be glad to talk to you about it. I'll see you on Wednesday.